Welcome back to Golden Bull. This isn't just a channel, it's a community of people who refuse to be exit liquidity. We position early, we follow the data, we track smart money, and we build conviction before the crowd arrives. Right now, crypto is at a structural inflection point, and today we're breaking down the hard data behind where this market is actually heading. Let's get into it. Everyone has a different idea of where the market is going, but I like to base mine on data and evidence. This is where I'm looking. Crypto is not random. It is being driven by measurable forces, macro liquidity, institutional flows, on-chain positioning, geopolitics, derivatives markets, and sentiment cycles. If you understand how they align, you understand what comes next. Macro liquidity, the core driver. The Federal Reserve policy rate has remained above 5%, maintaining restrictive monetary conditions. Historically, crypto bull expansions occur when real yields fall and liquidity expectations improve. The U.S. 10-year Treasury yield has hovered between roughly 4.2% and 4.8%. When yields remain elevated, capital prefers bonds, risk premiums widen, leverage becomes more expensive. M2. Global liquidity growth has slowed compared to previous expansion cycles. Crypto historically tracks global liquidity with a lag. When liquidity expands, Bitcoin leads. When liquidity contracts, Bitcoin compresses. Right now, we are not in aggressive contraction, but we are not in expansion either. We are in a neutral tight regime. That produces range behavior. Institutional structure. ETF and derivatives spot Bitcoin. ETFs have accumulated over $50 billion in net inflows since launch. That is structural institutional capital. Even during pullbacks, daily inflows of $200, $300 million reappear when risk sentiment improves. But here's something deeper. Bitcoin ETF options volume has grown significantly. Institutional derivatives participation is increasing. That means more hedging activity, more structured exposure, reduced emotional retail dominance. Open interest in Bitcoin futures remains elevated, often exceeding $20+ billion globally. When open interest spikes without price expansion, it usually precedes volatility events. Recent liquidation events during geopolitical spikes wiped out over $600 million in leveraged positions in short time frames. That tells you leverage is still active. Volatility resets positioning. The market is clearing excess risk repeatedly. On-chain metrics, supply and demand Bitcoin exchange reserves have risen recently, a short-term caution signal. However, long-term holder supply continues to trend upward. Coins held for 155+ days remain near historical highs. That means strong hands are not distributing aggressively. Whale wallets, 1000 plus BTC, have been net accumulating into dips. Altcoin exchange deposits are up roughly 22% year-to-date, suggesting rotation, not broad conviction buying. This creates a compression dynamic. Short-term uncertainty. Long-term structural holding. Compression precedes expansion. Price, structure, and market depth. Bitcoin has remained range-bound between approximately $65,000 and $70,000. Market depth metrics show thinner order books during volatility spikes, meaning when a breakout occurs, it can move quickly due to reduced liquidity density. Correlation with tech indices remains high, often above 0.7. Crypto is behaving like a leveraged tech asset. If equities break higher with breadth, crypto likely accelerates. If equities correct, crypto exaggerates. Geopolitics. Risk premiums. Middle East tensions have demonstrated a clear pattern. Oil spikes, gold rallies, dollar strengthens. Crypto pulls back. During escalation events, more than $600 million in futures positions were liquidated. This isn't structural bearishness, it's risk premium repricing. Geopolitics delays liquidity flow into risk assets, but does not eliminate structural demand. If tensions stabilize, risk appetite can return quickly. Geopolitics is a volatility trigger, not necessarily a cycle changer. Corporate and supply dynamics. Public companies have increased Bitcoin treasury holdings significantly. When corporations accumulate thousands of BTC and hold them long-term, that supply is effectively removed from liquid circulation. Available float decreases. When demand returns, price impact increases because fewer coins are available to sell. Supply compression is one of the most underappreciated bullish forces in this cycle. Sentiment and positioning. Fear and greed index remains in fear territory. Funding rates are neutral to slightly negative across many derivatives exchanges, meaning leverage is not excessively long. This is not euphoric positioning. It is cautious. Markets rarely top in caution. They top in greed. This is what I'm watching. Sustained ETF inflows. Multiple consecutive weeks of positive net flows would signal institutional conviction returning. 10-year Treasury yield. A meaningful drop below recent ranges would signal improving liquidity expectations. Open interest versus price. If open interest rises with price strength, that's bullish expansion. If open interest rises while price stalls, volatility risk increases. Exchange reserve trends. Exchange balances decline while price stabilizes, that signals tightening supply. Equity market breadth. If tech indices break higher with strong participation, crypto likely follows. Geopolitical headlines. Escalation creates short-term drawdowns. De-escalation restores risk appetite. Final conclusion. Where I think the market is going, I do not believe we are in distribution. The data does not support structural collapse. Institutional infrastructure is intact. Long-term holders are not capitulating. Corporate accumulation continues. Sentiment is cautious, not euphoric. What we are missing is expanding liquidity alignment. My base case: we remain in a compression and accumulation phase until macro conditions improve or institutional inflows become sustained. When that alignment happens, or liquidity, institutional capital, and sentiment turning together, crypto historically does not grind higher slowly. It expands aggressively. This market is coiling, and coiling markets resolve with force. Golden bull ending. If you found value in this breakdown, drop a like so the community grows stronger. Comment what you're watching: macro, ETFs, whales. Let's build conviction together. Subscribe if you want positioning before expansion, not after. Golden Bull is about data, discipline, and early positioning. We don't chase moves, we prepare for them. I'll see you in the next one.